Good morning, everyone. Today we're going to be starting off with Learning Unit 1. And remember, for Rsk4804, you should expect that there are going to be 12 learning units. And within those 12 learning units, please take note that when you go through those 12 learning units, make sure that you're always referring to your study guide, because it will tell you exactly what you should be covering in each of the textbooks that you're going to be using to go through these learning units as well. So there are going to be 12 learning units, and within those 12 learning units, there are different chapters that you're going to be expected to cover from the different textbooks that are recommended for this module as well. So please take note of that. So today we're going to start off with the Learning Unit 1. Now, because registration officially ends on the 31st of March, we are just going to cover the first chapter of Learning Unit 1, which is the chapter from the book by Bandyopadhyay, just to make sure that we don't move too fast to accommodate other students, because we are still expecting quite a lot of other students to join us as well. So which means that we just need to make sure that we don't move too fast, although we're going to make sure that whatever happens, by 31st of October, we should be done going to the different study units as well. So the expectation is by 31st of October, we should be done going to the different learning units. Then November, December, January, we concentrate on revision, where we go through past question papers as well as past assignments as well. So today we are starting off with Learning Unit 1. And as we are doing Learning Unit 1, you will see that there are 3 textbooks that they are recommending for Learning Unit 1 as part of the material that needs to be covered for Learning Unit 1. We need to cover Chapter 1 of Bandyopadhyay. We need to cover Chapter 2 of Whitney, and we need to cover Chapter 2 of C.B. Joseph as well. So these are the 3 chapters that we need to cover from the 3 different textbooks that we're expected to cover under the recommended textbooks as well. So today, we're just going to look at Chapter 1 of Bandyopadhyay. Then in the next class, we're going to move on to Chapter 2 of Whitney, and then also move on to Chapter 2 of C.B. Joseph as well. So the main agenda of Learning Unit 1 is where we're being introduced to credit risk, where we look at analysis and management of credit risk as well. So being introduced to credit risk, where we look at analysis and management of credit risk as well. So when you look at the chapter on Bandyopadhyay, you will see that under Introduction to Credit Risk, which is the first chapter that we're going to be covering under Bandyopadhyay, the lecturer says you have to work through Chapter 1 of the prescribed book by Bandyopadhyay with special attention to credit risk drivers, borrower level risk versus portfolio risk, management of credit risk in banks, role of capital in banks, the difference between regulatory capital and economic capital, credit risk management framework, and factors affecting credit risk. So any additional information relating to the topics must be sourced individually to your to add to your knowledge. So which means what the main learning outcomes that we need to take note of from Bandyopadhyay is under the self-test. So which means as we go through the textbook by Bandyopadhyay, we need to make sure that we are able to cover the self-test section, because this is where these are the potential questions that you can also expect to encounter when one goes through questions in the textbooks. So these are the potential questions that we're expected to cover, or that we can expect to encounter when we go through questions in the assignments, or as we go through questions in the exam as well. So we need to make sure that as we go through this chapter, we are able to go through the sections which addresses these questions as well. So the first one is that we should be able to know, what do you understand by credit risk? Explain the credit risk, why credit risk is considered a powerful driver in the economy. And the following link will direct you to the article that must be read. And the article identify 5 causes of or drivers of credit risk and advise what could have been done as well. So you can also go through this when you look at the article. So looking at this as well, remember they asked us to go through chapter 1 of CB Joseph. So they asked us to go through chapter 1 of CB Joseph. Now, when you look at chapter 1 of CB Joseph, so when you look at chapter 1 of Bandyopadhyay, chapter 1 of Bandyopadhyay looks at the introduction to credit risk. So here, on the first chapter, they say, credit risk is the potential that a bank borrower or a group of borrowers will fail to meet its contractual obligation and the future loss associated with that. So for most banks, loans are the largest and most obvious source of credit risk. However, other sources of credit risk exist throughout the activities of the bank, including the banking book and trading book, and both on and off balance sheet. So banks are also increasingly facing credit risk in various financial instruments other than loans, including acceptances, interbank transactions, trade financing, foreign exchange transactions, financial futures, swaps, bonds, equities, and options in the extension of commitments and guarantees, and the settlement of transactions. Since the exposure to credit risk continues to be the leading source of problems in banks worldwide, banks and their supervisors should be able to draw useful lessons from their experiences. Banks should now have a keen awareness of the need to identify, measure, monitor, and control credit risk, as well as determine that they hold adequate capital against these risks and that they are adequately compensated for risk incurred. So when we look at credit risk management, we are looking at it from a financial institution perspective, specifically. So when we are going to be looking at Rsk4804, you should know that whenever we are looking at credit risk management from Rsk4804 perspective, we are looking at it, we are analyzing credit risk management from the perspective of the lender. So we are going to be analyzing credit risk from the perspective of the lender on how the lender can manage credit risk. So you see that a typical lender is usually the bank. That's why you see that most examples that are going to be looking at there are going to be from the perspective of the bank. So what do we know when it comes to the bank? When it comes to the bank, the bank's accounting equation is typically your assets is equal to equity plus liabilities. So when you look at the bank's accounting equation, the bank's accounting equation tells us that the assets of the business or the assets of the bank, which are the ones that generate income or return, are financed by equity, which is what the owners of the business contributes, which is the capital, the owners what the owners of the business contributes, which is typically your ordinary share capital, or it's usually the liabilities, which is typically your debt financing. And what constitutes your bank debt financing for the bank? The debt financing for the bank is typically the money contributed by the depositors. Because remember, whenever the depositors put money into the bank, like for example, if you are holding an account with the bank, the money that the depositors contributed to the bank is basically the liabilities. Then there's also other debt that the bank is going to be getting as well, like for example, through loans that the bank is going to be getting from other financial institutions or other suppliers of credit as well. So which means when we look at credit risk management, the equity, which is the ordinary share capital, the equity, which is the ordinary share capital of the bank, is typically what we refer to as the capital of the bank. So it's typically what we refer to as the capital of the bank. Now, why are we talking about the financing of the bank? Because the bank is going to be financing its assets. And from these assets, the aim is for the bank to be able to generate a return. So the aim of the bank is to be able to generate returns. So which means, where do they get these returns? This is where the bank can give out loans, or the bank can invest in different securities as well. So which means they can give out loans to the borrowers, or they can invest in different securities, which are all with the aim of generating a return to the bank. We're on the same page so far when it comes to the accounting equation of the bank. Any questions? Any questions? Anyone lost? Now, one, in its pursuit of returns, remember we said they can invest in loans or they can invest in securities. In its pursuit of these returns, there are different risks that the bank is going to be facing in its pursuit of generating return. And one of those risks that we're going to be looking at specifically is credit risk. So there are different types of risks that the bank is going to be facing. And one of those risks that we're going to be looking at in particular is credit risk, which means for Rsk4804, we are going to be more concerned in analyzing the credit risk faced by the bank, although there are different types of risks that the bank is going to be facing, like, for example, market risk or operational risk, and so forth and so forth. So which means, what is this risk? The risk in this case is the risk that in pursuit of generating this return, the bank can suffer losses. So the risk in this case that the bank is going to be facing is the risk that in pursuit of generating these returns, the bank can end up suffering losses. So which means, if the bank suffers losses, the question now is the bank going to be having enough capital to absorb these losses? So which means, when you look at Rsk4804, when you look at the credit risk management, we're saying that we need to manage the credit risk so that we are going to be having enough capital available to absorb these losses. So you will see that later on in the curriculum, when you look at the Basel Accords and the evolution of the Basel Accords as well, you will see that the first losses that the Basel Accords accounted for was credit risk. But then they also realized that, no, but it's not only credit risk that a supplier of credit has to worry about. There are other types of risks that what the supplier of credit has to worry about. That's when you see that now, when you look at the evolution of the Basel Accord, they now see that, no, we have to take into account market risk. And then they also see that, no, we have to take into account operational risk. And then we also have to make sure that we have reserves for other types of risks and other events that might also result in potential losses. Hence, you see the evolution of the Basel Accord from Basel 1 to Basel 2 to Basel 2.5 to Basel 3. And even now, the Basel Accord is evolving. The main thing being, how do we ensure that we have enough capital reserve available so that if there's going to be any losses suffered in pursuit of the returns emanating from any of the risks there, those losses are going to be absorbed by capital. So now the question is, how much capital do we need to have and maintain here to absorb these losses? So from Rsk4804, we are now trying to analyze in deep, and we're trying to do a deep analysis of credit risk, which is one of the risk factors that contribute towards what? Losses that needs to be accounted for and catered for by ensuring that we have enough capital. So why are we so concerned about ensuring that we have enough capital? Because if the bank does not have enough capital available to absorb these potential losses that can be suffered in pursuit of returns, what is going to happen? The debt holders are going to be affected, especially the depositors, isn't it? So I worried about that. If there's not enough capital here and these losses are occurring, what's going to happen? If the capital is wiped out, we might have a situation where the debt holders might end up being affected, especially when you look at depositors. Because remember, depositors, they are trusting the bank to say, if I put 100 rand into the bank account, into my bank account to save money, at any point in time, whether it's today or it's 1 minute later, or 1 year later, or 10 years later, I should be able to withdraw that money. So which means that's how, if that confidence is not there, what is going to happen? People lose confidence in the financial system, and then you start hearing of people putting money under the mattress because they don't have confidence in the financial system. So which means, looking at this, when you look, whatever we're going to be covering in Rsk4804, it's all coming back to how do we ensure that we have enough capital available to cater or to absorb these potential losses, especially when you look at credit risk. Why? Because if we don't have enough capital to absorb these potential losses, the bank, which is the supplier of credit in this case, is not going to be in a position to continue as a going concern. And if the bank is not able to continue as a going concern, what is the ripple effect of that? It means, in that case, the depositors might end up losing their money. And if the depositors end up losing their money, the people lose confidence in the financial system. That's why you saw that a few years ago, when you look at the case of BBS Bank as well, where the moment that people heard that there was a problem with the BBS Bank, the depositors, they made a run, for the bank. And as the depositors made a run for the bank, what do we see? It means that in most cases, the bank will not be in a position to actually pay all the depositors, but we'll discuss that later on when you look at exactly how the bank make more money and how the money circulates within the financial system in such a way that there's a multiple effect of borrowing the same amount of money that is basically circulating within the financial system as well. Are there any questions so far? Any questions? So here they say, by definition, credit risk is the risk resulting from uncertainty in the counterparty's ability or willingness to meet its contractual obligation. So credit risk relates to the possibility that the loan will not be paid, or that the investments will deteriorate in quality or go into default, with consequent loss to the bank. So next, we look at the major drivers of credit risk. Before we look at that, is there any questions so far on what we've covered? Any questions? Now, looking at major drivers of credit risk, they say credit risk arises because in extending credit, banks have to make judgment about a borrower's creditworthiness, its ability to pay principal and interest when due. So this creditworthiness may decline over time due to change in its financials, poor management by the borrower, or changes in the business cycle, such as rising inflation, recession, weaker exchange rates, and increased competition. So the major drivers of credit risk are, please take note of these major drivers of credit risk, because I've seen historically some questions coming in. There's a structured question where you're be asked to state and discuss the major drivers of credit risk. So please take note of this because it's one of those common examinable questions. So let's say the first major driver of credit risk is default risk. And yet they say the obligor fails to service debt obligations due to a borrower-specific or market-specific factor. So which means when you look at default risk, this is where we're saying the borrower. So please take note that when they use the term obligor, they are referring to the borrower. So if they say borrower or they say obligor, take note of that. They are referring to one and the same thing. So if they say when the obligor fails to service their debt obligation, whether be it if they fail to pay the interest on the debt, or if they fail to pay the principal amount on the debt when it falls due, that is considered what? Default. So which means the risk that any one of those two or both of those two occur, this is what we're referring to as default risk. Then there's recovery risk, where they say recovery post default is uncertain as the value of the collateral changes unexpectedly. So which means we are basically saying when the default event happens, so when the default event happens, remember we said default is where we are saying that the borrower or the obligor can either fail to pay the interest when it falls due, or they can fail to pay the interest and the principal amount when it falls due as well. Which means when default happens, two things are likely to occur. There's going to be recovery, where if the default happens, we now find out exactly, so how much of the amount owed is the supplier of credit going to be able to get or recover? And then there's also going to be a loss given default. So which means in case of a default event, it's either the supplier of credit is going to recover some of the money, or they're going to lose some of the money as well. So now the question is, what percentage are they going to be able to recover on the money that are being owed? And what percentage of the money are they going to end up losing as well? So from which means from 100% of the amount owed, a certain percentage is going to be recovered and a certain percentage is going to be lost as well. So which means that's why we are interested in what? The relationship between recovery and loss given default as well. So they also look at, so when you look at recovery risk, we're basically saying, what is the risk that you're going to end up what you're going to end up failing to recover the amount that you're being owed as well, which means that what is the risk that you're going to end up having a loss given that the default event occurs. Then there's spread risk, where they say the credit quality of obligor changes leading to fall in the market value of the loan. So which means the market value of the loan is also going to be linked to the spread risk, because when the risk that the obligor is going to be failing to meet their obligation, like for example, due to the obligor credit rating going down. So which means that when the obligor credit rating goes down, it means that there's also a higher risk that they're going to end up failing to meet their obligation as well. Which means that if the obligor's if the obligor's ability to meet their credit risk goes down, it means that in that case there is going to be higher risk that they're going to end up defaulting on their obligation. So what does that mean? The interest that is charged on that debt obligation goes up. So if the interest that is charged on the debt obligation goes up, we know that the market value of the debt ends up going down, because we know interest rate and the market value of the debt, they move in opposite direction. So which means if the interest rate and the market value of the debt moves in opposite direction, it basically means that the spread risk now is going to be the relationship between the interest rate of a normal debt or of a government debt to the interest rate of a corporate debt as well, which means that when that relationship goes in, when the interest rate between those two increases, it means that you're also expecting that the market value of the corporate loan is going to end up going down as well. Because when you look at their relationship, we are saying the market value of debt and interest rate. Generally, they have this type of relationship where if the risk of the obligor goes up, the interest that is expected to increase as well. Because remember, when you now look at interest rates, we say the nominal yield is given as the real rate of return plus inflation premium plus risk premium, which means if the risk of the obligor goes up, the interest rate is expected to go up. And as we can see here, if the interest rate goes up, the market value of the debt that the debt holder is having goes down as well, which means because of this, it means that when you're now comparing, because of the high interest rate, it means that when you're now comparing the market value of a debt instrument by a corporate company with the market value of a debt instrument by a risk-free investment, like for example, government bonds, it means that when the spread risk is basically saying that when this interest difference is higher, you're expecting the value of your debt obligation to be lower as well. So which means because of this, it means that the spread risk is to do with the suppliers of credit because they are the ones who've invested in what? In the debt instrument. Are we on the same page? Any questions? Then there's also going to be concentration risk.
Question.
Yes.
Well, it's not really a question. I don't know why, but just struggling with the levels of your volume.
Flow.
Yes, the levels of your volume, it goes up and then it goes down. I'm not sure why.
Can you just check with your network connection? Because maybe it might be linked to the network connection. Can you just check with your network connection? Make sure that wherever you're sitting, make sure that where you're sitting, the network connection is also good as well. Because sometimes it's also affected by that.
All right, thanks.
I don't think it's the network here because I'm experiencing the same thing.
Yeah, same here.
Same here.
Is it much better? Is it better?
Yeah, that sounds better. Thanks.
Okay. All right. Okay. All right. So you find that when you look at the spread risk, that's basically where you look at the movements in interest rate or the changes in interest rates and how it affects the value of your debt as well. Which means if the value of your debt is basically going to go down because the interest rate has gone up, it also means that as the supply of credit means that you're more concerned about the value of the debt as well, because this is how you can be able to buy and sell this debt as well. Now, moving on to the next type of driver of credit risk, we look at concentration risk, where they say overexposure to an individual borrower or group or entity or segment. So which means when you look at concentration risk, we're basically saying what percentage of your book is is basically making up a certain particular type of borrower as well. Let's say, for example, if you are going to be looking at concentration risk, let's look at two banks. We have Bank A. So we have Bank A. Now, for Bank A, remember we're saying that in this case, Bank A, we have different banks and they're giving out loans. For example, let's say they're giving out loans to different customers, right? And in this case, when you look at Bank A, they only have two customers. So if customer they only have two customers. The first customer is owing Bank A 50,000, and then the second customer is owing Bank A 50,000, which means Bank A is being owed 100,000 in total. Then we look at Bank B. Now, when you look at Bank B, let's say in the case of Bank B, they are having 10 customers and each one of them owing the bank, let's say 10,000 rand as well, which means we have customer number one is owing the bank 10,000. Customer number two, 10,000. Customer three, so of the total 100,000, so of the total 100,000 that Bank B is being owed, each customer is owing Bank B 10,000. Now, the reason why we are concerned about concentration risk is mainly because now let's look at a scenario where for Bank A, if one customer defaults, if in this case, let's say it's customer X and customer one. If customer X defaults on their loan, it means in this case, the default rate is going to be equal to 50%. So if one customer defaults on their loan, the default rate is going to be 50%. So which means 50% of the amount of money that the bank is being owed, they are going to end up losing out on that money because one customer defaults. But for Bank B, if this customer ends up defaulting on their loan obligation, it means for Bank B, the default rate is going to be equal to, remember, it's 10,000 over 100,000, which gives you, so it's 10,000 over 100,000 times 100, which gives you 10%. So the default rate in this case is going to be 10%, and here the default rate is going to be 50,000 over 100,000 times 100, which gives us 50%. So what does that mean? Because Bank A was highly concentrated in giving two customers credit only, if one customer defaults, the default rate is going to be very high on their overall book. But for Bank B, because they've given credit to so many customers as well, if one customer defaults, their default rate is only going to be 10%. So this is basically what they mean by concentration risk, where they're saying the more concentrated the credit supply is going to be on a few customers, the higher the chance that the default rate is going to be high overall. But the more customers a particular bank has, the lower the default rate, mainly because what? The bank is more diversified. So the idea is when it comes to credit risk management for a particular bank, ideally, a financial institution needs to be having as many customers as possible, so that if one customer defaults, it's not necessarily going to be having a significant dent on the overall book of the organization as well. So that's why they look at the concentration risk. Are there any questions? All right. Moving on. We look at correlation risk, and let us say the common factors between different borrowers, industries, or sectors which may lead to simultaneous default. And that's what they look at when it comes to correlation risk. So when they're talking about correlation risk, they're looking at the common factors between different borrowers, industries, or sectors which may lead to simultaneous default. Now, when they talk about correlations, the correlation, you're looking at the relationship between the different factors of different variables as well. So you're looking at the correlation between the different factors of different variables. Like, for example, the correlation coefficient between different variables vary between -1, 0, and +1. For your correlation coefficient, any calculated correlation coefficient should vary between -1, 0, and +1. It should be found somewhere in between. When the correlation coefficient is sitting at +1, we say the variables are perfectly positively correlated. So they are perfectly positively correlated. And when the correlation coefficient is sitting at -1, we say the variables are perfectly negatively correlated. And if the correlation coefficient is sitting at 0, we say there is no linear correlation between them. So we say there is no linear correlation between the variables. Now, looking at this, so when you look at this, we are saying if the correlation coefficient between variables is perfectly negatively correlated, remember, it can also be found between 0 and -1. So it won't be perfectly, it will just be simply negatively correlated. And the correlation coefficient can also be found between 0 and +1. It won't be perfectly, it will just simply be positively correlated as well. Now, when you talk about perfectly negatively correlated, it means when you look at the behavior of the variables that are perfectly negatively correlated, we are saying if you look at variable m, if it's going to be moving in this pattern, it means that if a variable m is moving in this pattern, and we need to see exactly, so what is the correlation coefficient between m and variable n? Another variable would be variable n. Now, if they are perfectly negatively correlated, we are saying when this one is going up, this one is going down. And when this one is going down, this one is going up. So they are moving in opposite directions. So that's when we say They are perfectly negatively correlated, or they can be also having a correlation coefficient found in between here, although it's not going to be perfectly, although my drawing is not exact there, but we're basically saying generally, this is the general movements. They are moving in opposite direction. When one is going up, the other one is going down. Now, when you look at variables which are perfectly positively correlated, we are saying when you look at the behavior of these variables on a graph, if M is moving in this direction, we are saying N can be over or it can be below, but they are generally having a relationship where when one is going up, the other one is going up. And one is going down, the other one is going down. So which means when they are perfectly positively correlated or they're just generally positively correlated, we are saying when one is going up, this one is going up. And when this one is going down, this one is going down. And when this one is going up, this one is also, they're basically moving in unison over time. So if they're moving in unison over time, we say their correlation is positively correlated. Now, going back to our correlation risk, what do we see? When they are positively correlated, let's say, for example, you have stocks in BMW and you have stock in Mercedes-Benz as well. So what do we see? If anything happens in the car manufacturing industry, what are we expecting to do? If the whole industry is affected by a certain development, what do we expect to happen? The share price of both Mercedes-Benz and BMW is going to slide. So which means now, if you're having these two shares in your portfolio invested, it means you're running the risk that your portfolio is going to be running, is going to be having large losses. Why? Because these two shares that you're invested in, they are behaving in the same manner. Might not be exact, but they're behaving in the same manner, because if anything happens in the car manufacturing industry, you're expecting them to be both negatively affected. So which means this is what we mean by correlation risk. So which means when your correlation coefficient is closer to -1 is to +1, the closer your correlation is to +1, the higher the correlation risk. Because if, let's say, for example, you're invested in two shares and they are basically having the opposite. So if they are going to be behaving the opposite, it means that if anything happens in the industry that affects one share, you are expecting that the other share should be doing very well, especially when you look at the relationship between cyclical industries and gold, for example. You find that if you find where the cyclical industries and gold, when the economy is doing well, the cyclical industries usually do very, very well. But gold will be doing okay, but not as much. But then when the economy goes through a slump, a big slump as well, you find that these industries as well are going to be having a downward spiral. And what do people do? Usually, people look for safe havens for their investments. And one of the safe havens would be investment in gold as well. So which means you're expecting gold to do very well. Not necessarily, when you look at that example, it's not necessarily going to be perfectly negatively correlated, but there is some expectation that there should be a negative correlation there as well. So which means, what does that mean? It means as an investor or as a bank investing in these securities, so as a bank investing in these securities, the aim of the investor as a bank investing in these securities is to be as diversified as possible. And how do you diversify? By investing in securities which are having a correlation coefficient closer to -1 as possible. The closer your investments are closer to -1, the more diversified your portfolio would be as well. Are we on the same page? Reason being, if you invest in securities which are closer to +1, you are going to have a situation where your portfolio is going to be exposed to large losses if all your investments lose value at the same time. And if there's going to be large losses, what did we see? Large losses means that there might not be enough capital available to absorb those losses. And if there's not enough capital available to absorb those losses, what is going to happen? The bank's going concern is also going to be affected. That's why we are worried about correlation risk. Are we together regarding these major drivers of credit risk? Any question? So moving on. We look at factors affecting credit risk. When we look at factors affecting credit risk, we look at expected and unexpected losses arising out of adverse credit events. And then they say the factors affecting credit risk are as follows. When you look at how they affect the expected and unexpected losses. So the first factor that they discuss in this case is the exposure at default. So it's the exposure at default, then they talk about the probability of default, and then they discuss the loss given default, and then they also discuss the default correlations as well. So these are the factors. So I'm going to look at them, but as we look at them, so where they talk about these losses being, where they talk about these losses either being expected or unexpected losses. So they're saying the losses from these credit events can either be expected or unexpected. So the losses from these credit events can either be expected or unexpected. Which means when you look at these losses, we are saying the expected losses, we should be able to anticipate these expected losses. So the expected losses, we should be able to anticipate these expected losses. And how do we calculate to see how much the anticipated expected loss should be? We are going to look at it in detail in the coming chapters, but the expected losses are accounted for as, so the expected losses are calculated and accounted for by calculating the exposure at default multiplied by the probability of default multiplied by the loss given default multiplied by the term to maturity. So which means the losses that the organization suffers can be, the expected losses are going to be anticipated using this formula where we say the expected losses are given as your exposure at default to say how much is the customer owing the supplier of credit. So in determining how much the customer is owing the supplier of credit, this is the exposure at default. Then from there, depending on the credit rating of the customer, we can also be able to say how much is the probability that this customer is going to end up defaulting on their obligation as well. So which means from assessing the customer and using historical information as well, we can be able to determine the probability of default. We're going to look at it in detail later on. Then there's also the loss given default, where we are saying, in case default happens, how much of this is going to be the loss that we're going to be suffering as well, which means your loss given default, we're going to look at it in detail as well, is also given as 100% minus recovery rate. So 100% of what is being owed minus the recovery rate gives you the loss given default. Remember, we said in case of a default event, if you remember what I wrote previously, in case of a default event, two things are going to happen. Some of the money is going to be recovered that is being owed, and some of the money is going to be lost. So which means to find out exactly how much the money is going to be lost in case of a default event, we're going to say 100% of what is being owed minus what the percentage that is going to be recovered will tell us exactly what the loss given default is as well. Then the expected loss is also going to be dependent on exactly how many more years is this customer going to be owing us. So if this loan, how many more years does the customer have until this contract ends? Is the customer left with 3 years? Is the customer left with 1 year? Is the customer left with 5 years or 10 years as well? So your M is basically your term to maturity of the loan. So this is how we are going to be able to account for the expected losses. So which means, as we are pricing this loan to say, how much interest are we going to be charging this customer? We're going to be checking to see how much is this expected loss. Because the expected loss will determine exactly how much risk premium or how much interest rate we're going to be charging this customer. So which means the expected loss is going to be linked to our calculation of interest. Because remember, with the expected loss, we can now be able to determine how much risk are we taking. If we're taking too much risk, it means that the customer has to pay higher interest as well. Remember, we said your nominal interest rate is given as the real rate of interest plus inflation premium plus risk premium. And normally, the real rate plus inflation premium gives you the risk-free rate. Gives you the risk-free rate, and usually the risk-free rate, what they usually use as the proxy for the risk-free rate is where you look at the interest on government bonds, like for example, treasury bills. The interest on treasury bills is usually used as a proxy to determine the risk-free rate, which means when we're charging the interest on the customer that we're giving loans to, the interest that are going to be charging there is going to be highly dependent on the risk premium. And how do you determine the risk premium? We need to check to see how much is the expected losses that we're expecting divided by the what amount that we're going to be giving out to the customer as well. So the expected losses is going to be contributing towards what? Determining the risk premium as well. So the expected loss contributes towards the risk premium. But now, the question becomes, how do we cater for this unexpected loss? So the unexpected loss is now going to be absorbed or is expected to be absorbed by the capital of the business. So the unexpected loss is the one that's expected to be absorbed by the capital of the business. So that if the unexpected losses becomes too much, do we have enough capital available to absorb these unexpected losses? Are we on the same page? Any questions? Anyone lost? So where we look at the factors affecting credit risk, the first factor is the exposure at default. And remember, we said, please note, we're going to look at expected losses in detail as a chapter on its own. That's why we don't really, in the first chapter, I'm not going to be going through too much in detail because we're going to look at this as a separate chapter as well. So the first factor that we discuss here is the exposure at default. And remember, the exposure at default is the amount of the loan that is still outstanding in the instance where default happens. Then there's also probability of default, where we say is the probability that the obligor or counterparty will default on the contractual obligations to repay the loans. Then there's also loss given default, which is the percentage of exposure the bank might lose in case the borrower defaults, which is what we've discussed today. And then another factor is the correlations as well, where we say the default correlations, the default correlations measures the possibility of one borrower to default on its obligations and its effect on other borrower to default on its obligation as well. So we're looking at the ripple effect of one borrower defaulting on their obligation. So these are the factors that you need to take into account. So let's say credit risk is generally measured as a risk on individual counterparty transaction or default risk and portfolio risk. So the credit risk of a bank's portfolio depends on both the external and internal factors. So the elements identified for credit risk are shown in chart 1.1. And when you look at chart 1.1, they say credit risk can emanate from portfolio risk or it can emanate from transaction risk. When it emanates from portfolio risk, this is where you look at concentration risk. Remember, we've looked at concentration risk, where we looked at the risk of giving out credit to concentrating your credit supply to a few customers. And then portfolio risk also comes from intrinsic sector specific risk, where we're saying what are the risk factors that are affecting a particular sector as well. Then we also look at transaction risk, where you look at when you look at transaction risk, the first risk there is downgrade risk, where you say, so when it comes to a particular customer as well, what is the risk that their credit rating is going to be downgraded? Because if their credit rating downgrades, the higher the probability that they're going to end up defaulting on their obligation. Then there's also recovery risk. When you look at recovery risk, you're saying, so what is the risk that you might not be able to recover the amount that is being owed? Which means the higher the default, the higher the recovery rate. So the higher the expected default, the higher the expected default, the higher the loss given default, the higher the recovery risk as well, because it means you're not going to be able to recover that much. Then there's also default risk, where we say this is the risk that you're going to, the borrower might end up defaulting on either the interest obligation or the principal obligation or both the obligations as well. So are we on the same page when it comes to chart 1.1? Any questions? Now, when you look at borrower level or portfolio risk, so when you look at borrower level or portfolio risk, they say, when making credit decisions during lending, there is always a risk that the borrower might default on its contractual obligations to repay principal and interest. So the risk factors that are unique to the borrower causing them to default are called borrower-specific default risk. So the borrower-specific risk can be measured by using the credit rating, for example, borrower-specific probability of default, and facility-specific loss given default, and tracking the borrower rating movements. So portfolio risk arises from the composition of all concentration of banks' exposure to many assets to various sectors. So systematic factors are the external risk factors that affect the fortunes of proportion of the borrower in the portfolio. So concentration risk results from having a number of borrowers in the portfolio whose fortunes are affected by a common factor. So the common factor is also called correlation factor. So the systematic factor correlate the portfolio risk to changes in macroeconomic environment, like for example, changes in GDP growth rate, unemployment rate, or having fiscal deficit. So credit risk modeling is being extended into evaluating portfolio risk, especially in the areas of commercial and industrial loans, management of assets allocation in the loan portfolio, and portfolio monitoring. So the portfolio risk is influenced by idiosyncratic borrower-specific risk and external systematic risk. So the internal borrower-specific risk can be managed by adopting a proactive loan policy, good quality credit analysis, prudent loan monitoring, and sound credit culture. So the external risk factors can be managed by diversifying the portfolio, correlation analysis, setting norms for borrower and sector limits, and through effective loan review mechanism and portfolio management. Then we also look at the importance of managing of credit risk in banks. And yet they say credit risk management is important for banks because of the following reasons. And the first one that they give is where you look at market realities. And yet they say structural increase in non-performing assets, where they say these result in massive write-downs and losses as well. So which means that if there's going to be a lot of non-performing assets, it means that there's going to be you are going to be forced to sell these assets at a lower price as well, which means that you are going to be forced to write down the value of these assets or be forced to sell these assets at a loss as well. Then there's also higher concentration in loan portfolios, where they say overexposure to a borrower or related group of borrowers can pose risk to the earnings and capital position in the bank in the form of unexpected losses. Then we also look at capital market growth, where they say it produces a winner's case where the effect is due to increased competition as many companies have alternate channels to raise funds as well. Then there's also increasing competition, where they say higher competition among banks to book big loans, leading to lower spreads and net interest margin. So this is a primary concern for top management in banks as well. Then there's also another market effect, which is the declining and volatile values of collateral, where they say a decline or volatility in the collateral value warrants greater amount of credit risk due to uncertainty on loan recovery, which means in case of default, and remember, collateral is the security which is being used to say, in case of default, the lender can be able to fall back on that security to recover whatever they are being owed. Which means if that security is declining in value, it means the lender might not be able to recover the amount of money that they need to fully compensate themselves in case of default. Or if the asset is very volatile, it means that the lender might be forced to dispose of that asset at a lower price in the market to try to recover whatever they're being owed as part of what collateral as well. So that's the issue of the effect of what market factors. Then there's also growth of off-balance sheet credit products. And then they say the rapid growth of off-balance sheet products like various structured products, credit derivatives, etc., to trade the credit risk positions has heightened the need for more prudent bank regulation. Why? Because these off-balance sheet, balance sheet products as well, it's usually very difficult to value these off-balance sheet products. Like for example, when you look at the value of derivatives, remember we said a derivative is a financial instrument that derives its value from the value of the underlying security. So if you don't know exactly what is making up the underlying security, it means if you don't understand, remember when they come up with a particular derivative product, they will tell you that this derivative product they will give you the name of the product, but what you might not understand is exactly what are the other products that are inside that are driving the value of this particular derivative as well. Which means if you don't understand what are the products that are making up where the value of these derivatives being driven from, it basically means that there's also going to be a higher risk that if anything happens in the market, the value of that derivative is also going to be negatively affected as well. So that's one factor that you also need to take into account, which also affects what? Market factors as well. Are there any questions regarding any one of these market factors? Any questions? We also need to take into account the change in regulatory environment. And here we look at the evolution of the Basel Accords. Remember, we said the idea behind the Basel Accords is that we need to try to ensure that we have enough capital available to absorb these losses in case of a loss event as well. So which means over time, the Basel Accords have been evolving from Basel I to Basel II to Basel III as well. Remember, there was also 2.5, but basically to Basel III as well, right? So which means when you look at the evolution of these Basel Accords as well, the idea is that trying to ensure that we have a way of calculating and ascertaining how much capital needs to be set aside so that there's enough capital available to cater for these unexpected losses. So which means it's a very important factor that we need to take into account to ensure that we have enough capital available to absorb these credit risks that might be coming out from these return or income generating activities of the bank as well. And remember, when you look at the evolution of the Basel Accords, we also saw, although we're going to look at it in detail later on, in general, we see that initially the Basel Accords were more concerned with accounting for credit risk. So we need enough capital to account for credit risk. But over time, they also realized that there are other risk factors that can also result in large losses or large unexpected losses that we need to make sure that we have enough capital available for. That's why you see that the evolution of the Basel Accords is trying to take into account other risk factors over and above the credit risk factors as well. Then we also look at the reason why we see the importance of credit risk management is when you look at institution risk vision, where they say capital is a scarce resource, need optimal utilization. So the success or return in a project of a financial institution is observed by its stakeholders. So if the financial institution is engaging into new business or expanding its existing business, it requires capital as a buffer against the unexpected risk of losses. So institutional risk vision is very, very important to ensure that we have enough capital to cater for these unexpected losses as well. So the reason why we need to make sure that we maintain enough capital within the business. Why? Because we need to have enough capital to cater for these unexpected risk losses as well. Then the other factor under institutional risk vision is improve risk-adjusted return on capital and risk-based pricing. And we're going to look at later on how a financial institution can also improve the risk-adjusted return on capital. And one way is where, for example, in a financial institution asks the borrower to set aside a certain amount as deposit as well. And that deposit that is going to be set aside by the borrower can also be invested by the financial institution and generate a return as well. So here they say a risk-adjusted performance measurement framework would guide it to link its business growth targets, risk management process, and shareholder expectation, because the risk-adjusted return on capital is going to be used now to say how is this risk-adjusted return on capital is it enough or is it able to meet the minimum hurdle rate? Like, for example, if the minimum hurdle rate is to say, if ever we're going to be giving out a loan to a customer, that transaction should at least give us a return on a risk-adjusted return on capital of what? Of a certain amount, which means the hurdle rate is the minimum amount, and the minimum amount is going to be, let's say, for example, 15%, which means if we're going to be giving out credit to a particular customer, we should at least expect a 15% return. If it's not a 15% return or anything less than 15%, we would rather not give out that credit at all. So which means we're going to be using that hurdle rate to say, from these transactions that are generating, or that we're considering going into to give out credit, how much is the risk-adjusted return on capital? If that risk-adjusted return on capital is equal to or more than the hurdle rate, then you're now going to be using it to say, yes, we can go ahead and give out credit. So which means this becomes part of the institution risk vision as well. Are we on the same page so far? Any questions? Anyone lost? The practical example of how this is done, there is a chapter that we're going to be looking at, and where we are going to be looking at how how the bank would find out ways of ensuring that they're able to meet the hurdle rate by improving the risk-adjusted return on capital as well. Are there any questions? Anyone lost? All right, can we take a 10 minutes break until 12:35? Can we take a 10 minutes break until 12:35? Then at 12:35, we look at the role of capital in banks. So at 12:35, we're going to continue where we look at the role of capital in banks. So can we take a 10-minute break until 12:35? All right, can we continue? So we are there any questions before we proceed? Any questions? Any need for clarity on anything that we've covered so far? Is there any need for clarity on anything that we have covered so far? All right. So the next section, we look at the role of capital in banks, and where we look at the difference between a regular capital and economic capital. So we need to understand exactly what is the difference between regular capital and economic capital. So when you look at the difference between regular capital and economic capital, I'm just going to look at it from where I'm just going to give you or discuss the difference between the two types of capital. Remember, we said for the bank to ensure its going concern and mitigate the unexpected costs or unexpected losses, we need to make sure that there is enough capital available for the bank as well. So there are two main types of capital: regulatory capital and economic capital. So when you look at regulatory capital, remember we said to cater for these unexpected costs, we see that there's been the evolution of the Basel Accords. And when you look at the evolution of the Basel Accords, we look at the see exactly how much capital is required by the bank to maintain, supervised by the supervisor, which is usually the central bank, to ensure that there is enough capital available to mitigate these unexpected losses as well. And usually the formulation that is used in determining this regular capital, we refer to the Basel Accords, because when you look at the Basel Accords, we're trying to check to see exactly, so what is the minimum capital that the bank needs to maintain for us to be able to say the bank is in a position where it's able to maintain the going concern position as well. So when you look at the regular capital, the capital is prescribed by the central bank or by the supervisor, which is usually the central bank, to say what is the minimum capital that needs to be maintained to mitigate what? These unexpected losses. Then the economic capital is that capital that ideally the bank needs to maintain its what? Economic viability as well. So for the bank to maintain its economic viability, the minimum capital that the bank needs to maintain for the bank to be able to maintain its economic viability is what we refer to as economic capital. Why are we talking about this? Reason being, when you look at this capital, we see that, let's say, for example, you are looking at the calculation of the return on equity. Your return on equity is your net income divided by the value of equity. And usually we multiply this by 100. And this will determine exactly how profitable is the bank. So for us to be able to assess how profitable the bank is, we look at the return on equity. So which means for the bank to have a high return on equity, ideally, for the return on equity to improve, either the bank needs to improve its profitability by generating as much return as possible. But we know that because the bank is entrusted with other people's money, there are restrictions in these income generating activities as well. Which means another way that the bank can be able to improve the return on equity is by reducing the level of equity as well. So if they reduce the level of equity, when you analyze this equation, it means the bank should be in a position to increase their return on equity as well. Which means, but now, what do we know? If the bank reduces the equity, there is a risk that we might, in case of a loss event, the bank might not have enough equity available to maintain its going concern. So which means in that case, this is where you're now going to say, so what, from an economic perspective, for the bank to improve its profitability or the returns, how much equity must they maintain for them to be able to have a situation where they're able to maximize as much return on equity as possible as well. So now, what do we see? It means when you're now comparing the two capitals, the regulatory capital is the minimum capital that the bank needs to maintain. So even if the bank calculates the economic capital and they realize that they need to lower the capital to this much, but by regulation, they're not going to be allowed. So which means under any circumstance, the minimum capital that the bank must maintain is the regulatory capital. Although the bank is also encouraged to maintain its economic capital slightly higher. The reason being, the more capital the bank has, the more they are in a position to mitigate these unexpected losses when in case they happen as well. So this is where now why you find that if you look at countries like the US, if you look at what happened last year or the year before last year, where you look at the situation of Silicon Valley Bank, where you find that when usually the trend is usually that when different presidents come in, they usually come in and it's either they loosen the regulations, where they say how much regulatory capital they have to maintain. I'm looking at the case of US. South Africa is different. It's a bit more consistent, but I'm looking at the case of the US as well, where this is why you find that there's always going to be a fight between regulation and deregulation when it comes to the banking system in the US. Why? Because the regulation is going to be saying, maintain this much minimum capital. But the banks are saying, we want to be able to maximize our returns. We need to maximize the value of the firm and maximize the value of the bank. How do we do that? If we lower the capital, we should be in a position to maximize the return on equity. Because remember, to maximize the return on equity, the bank is already restricted on which income generating activities they can be able to use to pursue when it comes to the loans that they can give the securities. So which means, so it's either they have to fight to reduce this restriction on the income generating activities, or they have to fight to reduce the regulatory capital. Because if they reduce the regulatory capital, they're going to be able to maintain an economic capital lower as well, so that if they're able to do that, they're also going to be able to maximize profitability as well. And we know how the story went when it comes to that fight between regulation and deregulation. It's all to do with profitability. With deregulation, the bank is able to invest in more securities. And if they invest in higher risk securities, they're going to be able to improve the profitability. And with the deregulation, the bank is going to be asked to maintain a lower level of what? Regulatory capital, which means they now are able to compress the capital available. But remember, the risk there is that the bank might not be in a position to cater for these unexpected losses. So that's why you see that even when you look at the development since the 2008, 2007 financial crisis as well, this has always been the fight. This has always been the fight when it comes to the activities of the bank, where they're also saying that why should we allow the banks to be deregulated? Because some of these banks, they are too big to fail, such that the government is always going to be forced to bail them out. Why are they going to be bailed out? Because they don't have enough capital available to meet these unexpected losses. So if anything happens in the market. So are we on the same page when it comes to this issue of economic capital and regulatory capital, and why it is important in analyzing these as well? Are there any questions? All right. Moving on. On the next section, we look at the credit risk management framework. And when you look at the credit risk management framework, they say a financial institution or bank must know which, when, and how much credit risk to accept to strengthen bottom line, and also conduct proper evaluation of the default risk associated with the borrowers. So in general, protection against credit risk involves maintaining high credit standards, appropriate portfolio diversification, good knowledge of borrowers' affairs, and accurate monitoring and collection procedures. So when you look at, in general, they say credit risk management for loans involves involves one, borrower selection, where they say the selection of borrowers by using proper rating models and the delegation of rules that specify responsibility for taking informed credit decisions. And the second one is limit setting. Set credit limits at various levels to avoid or control excessive risk taking. So most banks develop internal policy statements or guidelines setting out the criteria that must be met before they extend various kinds of loan. So which means there must be limit setting as well, especially where we saw that there's also another issue of what? Concentration risk. So we don't want to have a situation where if there's no limit that is going to be set, where the financial institution ends up having their credit portfolio being exposed to particular customers as well, or a few particular customers. Then there's also portfolio diversification, where they say banks spread their business over different types of borrowers, sectors, and geographical regions in order to avoid excessive concentration of credit risk problems and conduct proactive loan portfolio monitoring. So in order to monitor and restrict the magnitude of credit risk, prudential limits have been laid down in the loan policy. So the portfolio quality is evaluated by tracking the migration of borrowers from one rating category to another under various industries, business segments, etc. Then there is also risk-based pricing, where they say implementation of a more systematic pricing and adoption of the risk-adjusted return on capital framework enhances the organization value. So the benchmark rate reflective of lending cost of the bank, which can be used as an appropriate markup to lend to various categories of borrowers. For example, a bank can formulate an interim pricing policy to price its borrower accounts based on the rating category. So a robust credit risk pricing model needs to generate a credit term structure consistent with the empirical properties. So banks should be looking for to formulate pricing models that reflect all of the costs and risks they undertake. So the pricing model should be realistic, intuitive, and usable by the business people. Then they also say credit risk management framework should enable the top management of banks to know which, when, and how much credit risk to accept to strengthen the bottom line. So it constitutes the following step. The first one being identify the risks, where the data capturing and identifying the drivers through various rating models. Then measure the risk, where you look at assessing in terms of size, timing, and probability, for which the bank should have proper systems and tools in place. And then manage or control the risk, which is based on these measures. Various reports can be generated that will help the management in avoiding, mitigating, offsetting, and diversifying credit risk in various portfolio segments. Then lastly, monitor the risks, where you look at categorize significant changes in risk profile or controls. So are there any questions regarding any of these? Are there any questions regarding any of these steps? Any question? They also say the sound practices of credit risk management specifically address the following areas: establishing an appropriate credit risk environment, operating under a sound credit granting process, maintaining an appropriate credit administration, measurement, and monitoring process, and ensuring adequate controls over credit risk. And remember, we are also going to look at in detail at the credit process of the organization. We're going to look at it in detail in the coming chapter as well. So in the coming study unit, that's when we're going to be looking at in detail the credit process. And it's one of those highly examinable questions as well in understanding the credit process of a particular or a typical organization. Then they also say the credit risk management process in a bank should aim at taking informed credit decisions, setting provisioning and reserve requirements against current or future levels of probability in order to measure risk-adjusted performance, establishing minimum pricing levels at which new credit exposures to an obligor may be undertaken, pricing credit risky in instruments and facilities and measuring regulatory capital charge following standardized or IRB approaches. We're going to look at it when you look at the Basel Accords or the evolution of the Basel Accords. Then measuring the actual risk capital or economic capital, and then calculating the risk-adjusted performance measures, such as the risk-adjusted return on capital as well. So which means this is what the risk management process should be able to achieve overall. Are there any questions on what we've covered so far? Any questions? Remember, in the chapter by Bandyopadhyay, they said, under self-assessment, we were supposed to address the following. What do you understand by credit risk? Explain why credit risk is considered a powerful driver in the economy. So which means these are all discussed when you look at the credit risk drivers as well. So please, so it means that we have managed to cover the two most important questions that needs to be addressed when you look at the section that we need to cover under Bandyopadhyay. Are there any questions? Any questions so far? Any questions on what we've covered so far? Any questions? So in the next class, we're going to be looking at chapter 2 of Whitney. And remember, this is all part of learning unit 1, where we look at credit risk analysis and management. So in the next class, we're going to look at chapter 2 of Whitney. When we're done with chapter 2 of Whitney, we're also going to look at chapter 2 of CB Joseph. And they are all introducing us to the concept of what? Credit risk management. Are there any questions? Please note that the timetable for our classes is already posted on the website. So the timetable for our classes is already posted on the website. So please take note of that as well. So please note that the timetable for our classes is already posted on the website. So today, I don't want to make our class too long. Reason being, we are also expecting quite a lot of students to enroll with us because registration is only ending on the 31st of March, which is in the next 2 days. So which means in the next class is going to be all hands on deck. Reason being, everything should be in order. There's no other reasons why we should not be covering as much material as possible as we go through the curriculum as well. So in the next class, we are going to be continuing with learning unit 1. Are there any questions? All right, if there are no questions, enjoy the rest of your weekend. Please take note of the timetable that is already posted on the website as well. I think I've already shared the link to the timetable on the different WhatsApp groups as well. All right, enjoy your weekend.